Hey everyone. Today I want to take the time and talk about life insurance and the basic things that we should all know about it. That way, when you're out there looking for coverage on yourself, you can make an informed decision based on your specific need. Now, you all may have heard those famous words of buy term, invest the rest that a lot of people live by. Well, I actually don't believe that there's one product that fits every single individual out there. So I want to walk you through three of the most common types of policies. Here we have a chart, and at the bottom are different ages, and towards the left-hand side, you will see the price of the policy from least expensive to most expensive. The first one that I'm going to talk about is a level term policy. With this policy, it can be issued from anywhere from as little as 10 years to as much as 30 years. After age 55, the most that you can usually take is a 20-year level term policy. This is where you're going to get the most coverage for the lowest price. Well, why is that? Well, one of two things is going to happen with this policy. Number one, you're going to pass away within that lifetime, within that time period, and your loved ones are going to receive the death benefits. And number two, you're actually going to outlive the policy. And after that comes, well, there's no more coverage, there's no more benefits. This type of policy is great if you want to cover something that's going to go away. So, for example, a mortgage, a car payment, or even covering your kids' colleges if you were to pass away before they actually get there. Now, the next type of coverage that I'm going to talk about is going to be whole life. Whole life is usually going to be the most expensive out of any other policy. But if I'm going to pay more, I better be getting something more. And that usually is what happens. The policy is permanent, and as long as you're making the monthly payments, you're going to keep this coverage. And that means that one day, whether you're 30 or 100, the policy is going to pay out those benefits. Now, the next type of insurance that I'm going to talk about is indexed universal life. Just like whole life, this coverage can be permanent. The payments are level as well as usually less expensive than whole life. So if you're thinking, well, why would I go ahead and get the whole life when I can get the same thing with an index universal? Remember what I said earlier. If I'm going to pay more, I expect more from it. Let's go into the next slide and compare some of the benefits that each of these policies have. This chart will allow us to compare the whole life, index universal, and level terms side by side. That way we can actually see which benefits go with which policy or which policy has these benefits. The first one is going to be guaranteed death benefit, which the whole life policy has. This will allow you to keep your actual coverage in place for as long as you're making the premium payments. Believe it or not, there are some policies out there that will terminate even though you're making your payments every single month. So make sure you have this option. The next one is guaranteed riders. Whole Life has it. And riders are actually just options that you can add within a policy. So, for example, the waiver of premium, that allows you to keep your coverage if you became medically disabled and can no longer pay for your policy. Well, guess what? If you have the waiver of premium, you don't have to make any payments as long as you're still disabled and can't work. The accelerated death benefit is something that's newer to the insurance industry. What this allows you to do is that if you were to have a terminal illness, you can actually use X percentage of the death benefit to help you pay for one last trip around the world with your family or do something with your family that you always wanted to do. So it allows you to use part of your benefit up front before you pass away. Not only terminal illness, but chronic illness. So, for example, if you can't do two of the five daily living activities, you can actually come in here and get a set percentage every year and help you pay for any medical bills that you may incur because of this disability. So also pretty cool to have with your life insurance policies. The next one is the cash value. And what this is, part of your payment actually goes to a separate savings account. Um, I've heard some people use it as an investment, and when they say investments is a horrible when they say life insurance is a horrible investment, well, I agree with them. It, life insurance, at least not these types of policies, should be considered as investments. This is just something that's nice to have in case you ever needed to tap into it. But it does have a option for cash value. Um, the reduced paid up, what that does is that there's going to be a time, maybe whenever you're 70 years old, 75 years old, that you can say, hey, you know what? I took out this $100,000 life insurance policy years ago, and I actually don't need $100,000 anymore in coverage. So what you can actually do is you can reduce your coverage, and there's going to be a chart that says, hey, at 70, at 75, you can reduce your coverage from 100,000 to 50,000 to 75,000, whatever that may be. And if you reduce it to this amount, the benefit of that is that you get to keep the coverage for the rest of your life, that reduced coverage for the rest of your life, and you actually never have to make another payment in your life. Well, let's say that even 5 years down the road, you say, hey, Omar, I don't need $50,000, $75,000 worth of life insurance. I'm actually self-insured now. Then you can always come back and terminate the policy, and you can keep the cash value of that. The extended term, this is something that I don't usually recommend, and that I personally don't like, but it is an option for people out there. What this does, it allows you to convert this whole life policy, this permanent policy, over to a term. Once again, they'll look at a chart and says, hey, based on your age or based on this or that, you can keep this full $100,000 in coverage that you initially took, but you can only keep it for 30 years and 3 days or something like that. They'll give you the time frame. But if you pass away within that time frame, well, yeah, your loved ones are going to get the full 100,000 that you took out years ago. But once that time comes and you don't pass away within that time period, guess what? There's no more coverage. There's no more death benefit. There's no more cash value. It's all gone. So something that I personally don't like, but like I said, it's still an option there. So whole life actually has all these, and these are guaranteed in the contract. This is why you're paying more for whole life, for guarantees like this. Now, when we look at index, well, yeah, it has the guaranteed death benefit, which is, like I said, is crucial. Uh, Guaranteed riders, yeah, you can add the waiver of premium, child term, a couple of others. You can add that. Accelerated death benefit, yeah, has that too. Cash value, well, this is why sometimes I like to call this index universal a maybe policy, because it may have cash value or it may not. What does it depend? Well, usually this policy is tied to an index, an investment, usually something tied with the S&P 500 or something along those lines. But if the index or the investment does well, guess what? You're going to have cash value. But if it doesn't produce well, well, you're not going to have any cash value. So that's what it depends on. It depends if the index uh, does perform well or if it doesn't. Reduced paid up, maybe. The reduced paid up amount depends on there being a cash value. If there's no cash value, there's no reduced paid up. So that's why it's the maybe there. If there is cash value, then there's a reduced paid up option here. Extended term, maybe, because once again, we go to it depending on the cash value. If there's cash value, there's an extended term option. If there's no cash value, there's no option for this, okay? Now we switch over to the term. Well, the term, guaranteed death benefit, it's guaranteed as long as it is for that term, the 10, 20, 30-year term. Once we're past that, well, there's nothing. Guaranteed riders, yeah, you can add the riders, but once again, they're only good for that time frame. Accelerated death benefit, same thing, only for the life of the term. Cash value, nope, that's not an option here, not even a maybe. Reduce paid up, nope, not an option. Extended term, well, this is actually already a term, but what this actually in most policies do have nowadays is that you can actually convert to a permanent policy within X number of years from you taking out this policy. So with one of the policies that I work with, let's say 10-year policy, you have 7 years to convert that into a permanent policy. So good to have with that. Um, Hopefully this PowerPoint presentation went ahead and showed you a little bit about the basics of life insurance. If you have any questions, feel free to reach out to me, blueladderfp.com, and hope you all have a great day. Goodbye.